For decades, index funds have been hailed as the holy grail of investing. The strategy is simple. Instead of picking individual stocks, just buy a piece of the entire market. Diversification? Check. Simplicity? Check. Long-term returns? Historically, yes, it seemed like a no-brainer. And when the greatest investor of our time, Warren Buffett, continuously recommended it to the average person, the advice became gospel. But something happened that's forcing smart investors to stop and rethink. Quietly and without much fanfare, Buffett's firm, Berkshire Hathaway, sold off all its positions in two of the most well-known S&P 500 index ETFs, SPY and VOO. This move, while small in dollar value compared to the size of his portfolio, carries weight far beyond the numbers. Why? Because it breaks the narrative we've been told for years. The one that says, just buy the index fund, forget about it, and enjoy compounding forever. If that's still the best approach, why would the Oracle of Omaha even bother selling? This isn't fear-mongering. It's a signal, a quiet but powerful shift that invites us to look under the hood of what has become a nearly religious belief in passive investing. Is the strategy still sound? Or have we entered a new era where index funds are no longer the safe haven they once were? Let's unpack what's really happening beneath the surface. Because the answer isn't just about Buffett. It's about how the structure of index funds might be fundamentally changing in a way that very few people are talking about. A strategy built on simplicity, but now facing complexity. The S&P 500 index fund was built on the idea that markets are efficient. By owning a low-cost index fund, you get access to 500 of the largest, most successful companies in America. You don't need to read earnings reports, analyze charts, or follow every market headline. As the American economy grows, so does your investment. This worked incredibly well for decades. Since its inception, the S&P 500 has returned, on average, over 10% per year. The math has been in your favor. The logic was hard to argue with. And for millions of people, this approach not only made sense, it made money. But here's what most people miss. The index fund is not a fixed entity. It evolves. Companies enter and exit. Weights shift. And most importantly, the behavior of investors changes the behavior of the index. When trillions of dollars flood into a single investment vehicle, it alters its very nature. Passive investing becomes an active force. And suddenly, the safe index is no longer simply reflecting the market, it's driving it. This brings us back to Buffett. His firm didn't just sell stocks. It sold two of the most recognizable ETFs tracking the S&P 500, effectively stepping away from the classic index fund strategy. Even if the amounts were small, the message is loud. The risk-reward equation might be changing. What happens when everyone buys the same thing? In a world where index funds are the go-to for retirement accounts, employer plans, and beginner investors, the assumption is that diversification protects you. But what if that's no longer true? Let's look at the data. In 2015, the top 10 companies in the S&P 500 made up about 18% of the index. Today, they represent around 40%. That means when you buy the S&P 500, nearly half of your money goes into just 10 companies. Names like Apple, Microsoft, Nvidia, Amazon, and Meta. You're no longer buying 500 companies. You're betting on 10 giants and sprinkling the rest. That's not diversification. That's concentration disguised as safety. Worse still, the valuations of those top companies are extraordinarily high. Their price-to-earnings, PE, ratios average in the 30s. This means that their earnings don't grow significantly in the near future. Investors will be sitting on overvalued assets. And when prices don't justify earnings, markets correct, sometimes sharply. It's no wonder Buffett and others are quietly backing away. Michael Burry's warning. Have we seen this movie before? If you've seen The Big Short, you know the name Michael Burry. He famously predicted the 2008 financial crisis and made hundreds of millions by betting against the housing market. Today, he's issuing a similar warning, this time about index funds. According to Burry, passive investing has created a distorted market where capital flows are no longer based on fundamentals, but momentum. People aren't analyzing stocks. They're not checking balance sheets. They're just dumping money into index funds because that's what you're supposed to do. He compares it to synthetic CDOs of 2007, complex financial instruments built on subprime loans that few investors actually understood. Back then, it was blind trust in ratings. Now it's blind trust in the index. What happens when the flows reverse? When people stop contributing? When redemptions begin? Burry says, it will be ugly. That's not fear, it's insight. And when the man who predicted the last great collapse is saying history might be repeating itself, it's worth paying attention. Valuation matters. Always has. Always will. Here's a basic investing truth. The price you pay determines the return you get. Let's say a company earns $10 per year. If you buy its stock for $20, you're earning a 50% return annually. But if you pay $200 for that same $10 in earnings, your return drops to 5%. Now apply that logic to the index. The S&P 500's current P/E ratio is around 28, almost double its historical average of 15. That means the market is expensive. And when you buy expensive assets, you lock in lower future returns. Some analysts now argue that expecting more than a 3% to 5% annual return from the S&P over the next decade is optimistic. At best, that's before inflation. After taxes and fees, it's even less. Are you okay with that? Would you be satisfied earning 2% or 3% per year on your life savings? Because that's what many index investors are unknowingly signing up for. So why did Buffett sell? Let's clarify one thing. The total sale of SPY and VO by Berkshire Hathaway amounted to around $45 million. Compared to the firm's $267 billion portfolio, that's just 0.01%, a drop in the bucket. Also, these trades were likely made by Buffett's deputies, not the man himself. But optics matter, headlines matter, and behavior, even in small doses, signals sentiment. Buffett bought those ETFs in 2019 when the S&P was around 2,900 points. He sold when it was near 6,000. That's a 2x return in 5 years. Not bad, but perhaps now, with valuations stretched and risks rising, he or his team sees better opportunities elsewhere. So while the headlines scream Buffett dumps index funds, the reality is more nuanced. Still, it raises a question that all investors must ask themselves. Is now the right time to hold the index or walk away? There's no one-size-fits-all answer. But blindly following outdated advice in a rapidly changing market is a risk all on its own. Which side of the conversation are you on right now? Do you believe index funds still make sense for long-term wealth? Or are you starting to question the logic like Buffett and Burry? Share your thoughts below. I'm always curious to hear how others are interpreting these shifts, and your comment might just spark a powerful discussion. Also, if you're enjoying this deep dive, consider sharing it with someone you know who still believes index funds are a no-brainer. Let them see both sides of the story. Passive investing was designed to be the antidote to bad investing decisions. The concept was beautiful in its simplicity. Stop trying to beat the market. Just join it. Let the market work for you. Let compounding do its magic. Let time be your ally. But now, a growing number of financial thinkers are beginning to whisper what few dare say out loud. What happens when too many people do the same thing, the same way, for too long? At what point does passive investing stop being smart and start becoming a systemic risk? It's not a hypothetical anymore. It's already happening. Index funds were meant to protect you from risk. Now they're concentrating it. One of the most common arguments in favor of index funds is diversification. You're buying a slice of 500 companies, they say. You're spreading out your risk. You don't have to worry if one company collapses because hundreds of others will balance it out. But let's take a closer look. In the current S&P 500 index, over 40% of the total market weight is made up by just 10 companies. That means when you invest in the index, nearly half of your money goes into names like Apple, Microsoft, Nvidia, Amazon, Meta, and Tesla. Instead of owning 500 companies, you're really betting on a concentrated handful of mega-cap tech giants, many of which are already mature, highly priced, and heavily owned. The promise of broad exposure has become a hidden concentration risk. Even billionaire investor Chamath Palihapitiya weighed in on this problem. He explained that most people think they're investing in the 500 best companies in America, when in reality, they're putting a large part of their money into 10 or 12 stocks. The rest? Just passengers. Here's the danger. If one of those major companies stumbles, the ripple effect on the index and your portfolio could be enormous. You're not protected by diversification if your exposure is concentrated in companies that move in lockstep. The myth of set it and forget it. One of the most damaging pieces of financial advice today is just buy the index fund and never think about it again. While that may have worked in the 1990s and early 2000s, today's investing environment is radically different. Back then, index fund investors were a minority. Today, passive investing dominates the market. In fact, it's estimated that over 50% of U.S. equity assets are now in passive strategies, many of them automated. Every time a paycheck hits your 401k, money is automatically siphoned into the S&P. No questions asked, no valuation checks, no analysis, just flow. This creates a powerful loop. Money flows and the top stocks rise. The index fund looks strong. More money flows in. But like any cycle based on momentum instead of fundamentals, it's vulnerable to reversal. And when that reversal begins, when investors start pulling money out, the same loop that lifted prices could drag them down even faster. When smart money starts stepping back. We've talked about Warren Buffett. We've covered Michael Burry. But they're not alone in sounding the alarm. Jeremy Grantham, co-founder of GMO and one of the most respected value investors alive, has also issued repeated warnings. He believes the current stock market is in a super bubble, one driven not by strong earnings or economic fundamentals, but by speculative flows into the same overhyped names. Grantham points to inflated valuations, uncritical enthusiasm, and the blind trust investors have placed in passive vehicles as warning signs. He even predicted a major correction, one that could wipe out a decade's worth of gains in a matter of months. The common thread here is not pessimism, it's pattern recognition. These are investors who have seen bubbles form and burst before. And they're telling us that what's happening now in the index fund space is dangerously familiar. A bubble by any other name. Let's revisit what a bubble looks like. Rising asset prices not backed by proportional earnings. A flood of capital into the same assets, with little scrutiny. Widespread belief that this time is different. Lack of understanding by the majority of investors. A trigger that reverses flows. Then panic sets in. Check each one off. The current index fund craze ticks every box. Think about this. When you buy an index fund today, do you know the valuation of each company inside it? Do you understand how much you're paying per dollar of earnings? Have you assessed their debt, growth potential, or sector risk? Chances are the answer is no. And that's not an insult. It's a very design of passive investing. It tells you not to think. Just invest. Just follow. Just trust. That's exactly how investors acted before the 2000 tech crash. It's how they behaved before the 2008 housing crash. And now, it's happening again, only this time with ETFs and index funds at the center of the financial universe. The hidden costs of overconfidence. Another issue few discuss is price discovery. In a healthy market, prices are set by buyers and sellers evaluating real company fundamentals. But in a passive-dominated world, capital allocation is no longer driven by informed decisions. It's based on inflows. This distorts the very mechanism that keeps markets efficient. Michael Burry put like this: passive investing has removed price discovery from the equity markets. He compares it to synthetic asset-backed CDOs of 2007, which bundle subprime loans and price them without understanding the risk. Sound familiar? When markets aren't functioning properly, when assets are mispriced, and when investors are blind to what they actually own, corrections are not just likely, they're inevitable. The real question, what are you really buying? Imagine someone offers you a business. You don't know what it does. You don't know how much money it makes. You don't know its debt or whether it's growing or dying. But the pitch is simple. It's part of a basket of other businesses. Trust me, it's safe. Would you say yes? That's exactly what millions of people are doing with index funds today. They're investing not based on knowledge, but on habit and hearsay. And while that's not always a recipe for disaster, it becomes risky when valuations are stretched market concentration is high, and expectations are disconnected from reality. So what's your view now? Does it still feel right to put your faith and your money into a basket of companies you haven't evaluated yourself? Or is it time to revisit your strategy and think more critically about where your future wealth will come from? Drop your perspective in the comments below. Sometimes just starting the conversation can open new doors. And if you know someone who's riding the index fund train without ever questioning the destination, send them this video. Let them see what the data and the experts are starting to reveal. If you've been investing in index funds for years, hearing all of this might feel like an attack on common sense. After all, index funds have worked. They've built fortunes. They've simplified investing for millions. So how could something so proven become a potential problem? The answer lies not in whether index funds worked in the past, but whether they will work the same way in the future. Markets evolve. Tools that once offered an edge can become outdated. And when a strategy becomes too popular, it often loses its original advantage. The tragedy isn't in using index funds. It's in trusting them blindly without questioning whether the landscape has changed. So let's look ahead. What can investors do now, knowing what we know? Step 1. Understand what you own. If you hold an index fund, take time to study its composition. Go beyond the ticker symbol and explore the actual companies inside it. Ask, what percentage of this fund is concentrated in tech? Are the top 10 companies fundamentally strong or overvalued? Am I comfortable with the P/E ratios of these stocks? Would I buy them individually at today's prices? You don't need to become a professional analyst, but even a surface-level awareness can separate you from the herd. Remember, ignorance isn't a strategy, it's a liability. Step 2. Reconsider the set-it-and-forget-it mentality. There's a big difference between long-term investing and blind investing. Long-term investing means staying the course through volatility, with a strategy based on facts. Blind investing means never looking at what you own because someone told you it's safe. If the world is changing, if valuations are stretched, returns are shrinking, and risk is building, you owe it to yourself to adapt. Set a schedule to review your portfolio twice a year. Ask if your current allocations still match your goals, your risk tolerance, and your timeline. You don't have to micromanage, but you do have to manage. Step 3. Explore alternatives cautiously. We're not saying dump your index funds and go all in on crypto. That would be replacing one extreme with another. But consider these alternatives. Dividend-paying individual stocks, often more stable, with cash flow even in stagnant markets. Value funds. These focus on companies trading below intrinsic value, often offering higher returns with lower risk. Global diversification. U.S. markets have been strong, but other regions may now be undervalued. Alternative assets, real estate, precious metals, or even private equity may offer inflation-resistant growth. The key is not abandoning index funds, but complementing them with intentional strategy. Diversify not just across companies, but across ideas. Step 4. Adopt a valuation mindset. One of the biggest takeaways from Buffett's philosophy is this: price matters. It doesn't matter how good a company is. If you overpay, your returns suffer. This applies to stocks, real estate, or even index funds. No asset is immune to the math of valuation. Train yourself to ask, what am I getting for the price I'm paying? This simple habit can protect you from hype bubbles and emotional decisions, and it might be the most powerful investing tool you'll ever use. Step 5. Be willing to think differently. The greatest danger in investing isn't market volatility. It's mental rigidity. When we cling to old ideas in a new world, we invite disappointment. The truth is, index funds may still have a place in your portfolio, but they no longer deserve the untouchable status they once held. You owe it to yourself to question, to learn, and to evolve. Because in the end, no one will care more about your money than you. If this video helped shift your perspective, even just a little, do one thing before you forget. Check if you're subscribed to the channel. A surprising number of people watch every video, but never subscribe. And if you're not subscribed, you might miss future episodes that help you protect and grow your wealth. So take a second, Click that button and activate the notifications so you never miss a new insight when it matters most.